Hello again. We're going to be very prolific today. 2 videos in one day, which is good. I have a little bit of time, so I'm trying to knock out these. Let me start over because it looks like maybe, just maybe, my YouTube stream just came up, just to make sure. This is part 2 of the, which is actually the 3rd video if you include the teaser for the stock options, how to use stock options video series. Again, Ken Creager from Black Swan Financial Advisors. All of my videos are for educational purposes only. I hope you find them valuable and useful, and tune in. Like I mentioned in my other videos, I am putting together a more detailed, it'll probably be like a recorded webinar or a more detailed series of videos with maybe a workbook or something. I'm putting together a course essentially for advanced options that are going to go into much more detail, a lot more hands-on examples than these videos, which is a premium content, but it won't be very expensive, but you can get access to more advanced options training or information. Again, I'm a founding member, sponsor of the Community of Possibilities Achieved, a collaborative community focused on families with family members with special needs, place for them to get information. It's a place for educators and caregivers and attorneys and lawyers and financial planners and educators, employment specialists. My daughter has she has Down syndrome. You can see her right here, Addie. She has her own little freeze-dried goodies by It's Me Addie. So we support employment opportunities. Just a community for everyone, anywhere, that provides resources and support for families with special needs. So please encourage people to join. You join. So we'll jump right into this. Like I said, this is technically video number 2, which is video number 3. But we're going to talk about pricing and time decay and understanding some of the basics about what goes into the pricing of a stock option. Again, a stock option is the option, the right to buy or sell a stock, but not the obligation. So a call option is the right to buy, and a put option is the right to sell. And if you go to video number 1, I talk about, what are call options and what are put options. So you probably need to watch these videos in order. But now we're going to talk about, well, how do the prices get set? And again, options are contracts. They're a financial contract. They're not actually buying or selling the stocks themselves. You don't own any stocks unless you exercise those options. Like a call option, if you exercise it, you'll pay the money and you'll buy it at whatever the strike price was that you bought that call option at. So how do these options get priced? So it's kind of interesting. You can buy and sell the stock directly, and you can buy and sell the options directly. And most options expire worthless, but during their lifetime, they only exist for a certain period of time. During their lifetime, those options contracts get bought and sold all the time, just like the shares do. And so you can buy or sell a stock option. There's volume. This is really, really important when it comes to doing options on, companies that you just want to buy or whatever. So you'll notice that when you go look at the options chain and you look at the options for a particular company, some companies like Microsoft or Amazon or whatever, they have options that expire every week out, like maybe 2 months, and then every month, and then every 3 or 4 months. But they'll have options out like a couple of years. The S&P ETF, the SPY, it has options that go out several years. So how do they get priced? You buy and sell these options contracts separately from the stocks themselves. They control 100 shares of the stock. So one contract, one options contract controls 100 shares. So you have the right to buy or sell 100 shares. So what goes into the value? These are just these are the main things that affect the price of the options contract itself. Interest rates, I didn't write them down here, but they can especially it depends on the type of company and stuff, but interest rates seem to affect just about everything. But the options contract price is going to be related to the current price of the stock. So if you have a stock that costs $1,000 a share, the options are going to be way more expensive than a stock that costs $100 a share, which will be way more expensive than one that costs $10 a share, which will be way more expensive than one that costs $1 per share. And actually, you might not have a lot of the over-the-counter stocks, a lot of stocks don't have options on them at all, or they'll only have a very few choices in options, and the spreads, the bid and the ask on those options can be really big. So the same way that you like to have liquidity, like with a Microsoft or a Google or something like that, you want lots of shares trading and everything. Liquidity can affect the pricing of options. I didn't have that in here either, but I do have the volatility. So in some ways, options prices reflect the volatility of a stock, because what it is it's a contract and it's related to time, and what it's basically, it's guessing what the value of a stock is going to be in the future. Okay, so if you buy a call option on $100 with a $100 strike price on a $100 stock, you do that because you think at some time in the future, maybe 2 months, that it's going to be worth 120, right? But if a stock moves up and down, is really volatile, like Tesla, say for example, big price moves relative to Walmart, or even another company like Johnson & Johnson, right? Tesla's option premiums, the pricing is going to be higher relative to the strike price, to the prices than Walmart, because Walmart and Johnson & Johnson are a lot less volatile stocks. And so anyway, the volatility will affect the price. And then there's really kind of two parts of value that you hear about all the time. And one is the intrinsic value of the stock options price, and it's the portion of the option premium. You'll hear premiums all the time. That's the price that reflects the current underlying asset's price relative to the strike price. So very simply, if the current price of a stock is 100 and the strike price is 90, there's a $10 difference. The intrinsic value of that options contract is $10, okay? Time value has to do with the portion of the options premium that reflects the potential for the option to increase in value over time. And time value is really, really interesting, and this is what makes options super powerful, actually. So let me show you this little chart, because this is very eye-opening. So the time decay of an option, and this is why most options expire worthless. And this is why you can get a pretty good premium and get a discount. We looked at the Microsoft one in video 1, where the current price was about $278, and I could have sold a put with a strike price of $275. So that's $3 of intrinsic value. The option only had like 3 days until it expired, right? And if I sold the put, I could have got like another $3 or whatever it was. And so there was an intrinsic value, the difference between the price and the strike price, and now there's time value. And you can see by this chart that in the last 30 days, the time value drops off dramatically. And if you're the seller of a put, then that means that you're making money really fast, okay? Somebody paid you, say, $3 a share back, 60 days ago. And by the time you get to 30 days, it's lost half of its value. But then when it gets down to a week, look at how fast that drops off. And then you'll be owning, you'll get to keep all that money. So this is why this time value is, it expires, has an expiration date, that contract does. So the time value can be really powerful and very helpful for like sellers of options, because what you want, if you're just trying to sell the options and keep the money, basically generate some income, either sell a call against stocks that you already have or sell a put to maybe get stocks. A lot of people trade them just, they actually don't want to put the stock at all. They just want the money. So they'll use this to generate income. And so they're just actually hoping that, the stock that the thing will expire worthless and nothing will happen. So it actually works great in a sideways market, because it's a way for you to, 30 to 60 days out, you can sell a covered call on some stocks that you own, or sell a put on a Microsoft or a Walmart or something, and then it'll expire worthless and you keep the money, and then you do it again and you do it again and you do it again. So last little thing here, let's do some hypothetical examples of value. Very simplistic, but let's just say we have a stock, the current price is $100. This is a call option, so that you can kind of keep that in mind. This is the right to buy. So current price is 100, and I'm gonna buy an option that gives me the right to buy it for $95, and it's a 1 week out. I had to pay $10. Well, the difference, whoops, what did I just do there? The difference between the strike price and the current price is $5. So there's $5 of intrinsic value, but it costs me $10. So there's still $5 of time value in there. And then say, for example, it comes down to Friday, options expire on Friday. And what's happening is my strike price is still 95. The current price is 100, say, so I still have $5 of intrinsic value. But the price of the option itself might actually just be, $6. It might only have $1 of time value, and it'll go down and down and down. But it's really interesting because a lot of people have started trading like daily options. You can go in and you can see premium time value during the last day, the market's only open for 6.5 hours, and you can see there's significant time value down to the last minute, especially for strike prices that are near the current price. Okay. So say we go get one that's 30 days out. This strike price is 90. And so I have $10 of intrinsic value, the difference between 90 and 100. But the options price is $18, right? So that means I have $8 of time value. And you'll notice that, the difference, 1 week to 30 days, there's, the further and further you get out, the flatter the curve, right? Back to this little chart here. It gets flatter and flatter. So the value keeps going up, but not as quickly. And then if you go 90 days out, you go another 60 days, maybe you only get another $2 of time value. We still have the intrinsic value. Okay, and then that gives you a share price. So options contract price, and the prices that you see in the contracts are per share. Okay, so let me jump back. I'll jump back to this little video here because it's very useful. These prices right here are the price per share. Okay, so look at the value here. If I go with the 277.50, the intrinsic value is only $1.37. But look, it's worth $3, right? So there's actually more time value than intrinsic value right now. And usually the max premium is going to be for strike prices on options contracts that are right near the current price. So this is a call option. If I wanted to buy this 277.50, I'd have to pay $5.10 per share, which is $510 per contract. Okay, but I only have $1.37 of intrinsic value. So the rest of that, $1.37 to $5.10, that's all time value, and that's time value in the last week. So that's kind of crazy. So anyway, this video has been for educational purposes only. So remember, intrinsic value, time value, volatility, you know, the price of the stock itself. I don't typically do options on positions that cost hundreds of dollars per share because you're dealing with 100 shares. Your obligation or your potential, it's the right, but not the obligation, but you could be on the hook for the whole amount. 100, say you got a $500 per share, or, you know, like when Amazon was over $1,000, 100 shares would be $100,000. And actually, most accounts require you to have margin, permissions to do margin. You can do some basic options like selling puts and covered calls in retirement accounts, but that's only if you have enough money in there to cover a trade if you get put the stock, or, you know, if the transaction goes through. So anyway, the advanced course will give you lots of really good details. And we'll get some more details in the next videos. Thanks again for joining. Please remember my community at Possibilities Achieved. Ken Creager from Black Swan Financial Advisors. Educational purposes only. We'll see you at the next video.